With this chapter, we're going to be discussing capital investment analysis. It's really how are we going to decide whether or not we're going to invest in certain fixed assets over others. And we're really going to be looking at 4 analytical tools. We're going to be looking at two methods that do not use present value and 2 methods that do use present value. And we'll talk about what present value is in a second. Methods that are not going to use present value is going to be the average rate of return method and the cash payback method, and the ones that do use present value are going to be the net present value method and the internal rate of return method. With that, we're going to start off, well, let's look at how that lays out here. Average rate of return method, not too many people use that. Cash payback method, 53% of the people use that. Net present value method is by far the most popular. It's not too difficult to calculate. And the internal rate of return method, 76%. Now, the idea here is that these first two, as I mentioned, do not use what's called the present value method, the time value of money. And these do consider something called the time value of money, which is the present value method. The time value of money concept basically shows you that $1 today is worth more than $1 tomorrow. What that means is your buying power changes from day to day. So, $1 today will buy you a lot more than $1 5 years from now. $1 5 years from now will, let's just say that $1 today could buy you a loaf of bread. Well, that same $1 5 years from now won't buy you a loaf of bread, right? So that's the idea of the time value of money. Have you ever thought to yourself, well, why, have you ever played the lottery? And usually you play the lottery and you choose whether or not you are going to go with the cash payout method or the annuity method. Well, that actually, and if you go with the annuity method, maybe you win $20 million, but if you go with the cash payout, you get something like $8 million. Now, if any of you have ever questioned why that is, the majority of the reason is due to the time value of money. The idea is that if you're going to get all that money today versus $20 million over the next, say, 20 years, if you're going to take all that money, what is the value of that same amount of money 20 years from now? Today, it's worth less. Okay? So that the idea is if you got that $8 million today, it could grow to $20 million over the next 20 years. Okay, so $1 today is worth more than $1 would be tomorrow. I hope that helps a little bit. It's really difficult to explain the time value of money through a screencast. Okay. So the first method, as I said, we're looking at is the average rate of return method. And the idea is you're trying to decide how much income an investment is going to bring you as a percentage. So the calculation isn't too difficult. It's how much is your annual income, how much do you expect your average annual income to be, divided by the average investment, which is initial cost, the cost of the investment, plus any residual value, if any, divided by 2. So looking at this with the information that's given to us here, we've got the machine cost that we're looking at buying being $500,000 and the residual value being 0. Well, that's your denominator here, as it said before, your average investment, $500,000 plus 0 divided by 2. And the total income that's going to come from this machine is supposed to be $200,000. Well, there you go. But that's over 4 years. So you're talking about the total income from this machine is going to produce from you over the next 4 years is going to be $200,000 divided by 4 years. All right, so $50,000 a year. So the idea here is that this machine is going to earn you every year $50,000, and the annual investment, the average investment for this machine is going to be $250,000. So you're going to earn a 20% return. This machine is going to make for you each year 20% of the cost of this total machine. So with that, you might decide whether or not that is a good rate of return for you. That's a decision that only you could make in your business. Okay. People like the average rate of return because it's easy to calculate. You're looking at the total amount of income earned over the entire life of the machine. And don't worry, it emphasizes accounting income. I'm not going to go into that. Okay, disadvantages is the main disadvantage is you're not considering the time value of money, and you're not going to consider the timing of the cash flows when they're coming in. It said that that machine was going to earn for you $200,000 over 4 years. Well, maybe it's going to earn $100,000 the first year, $50,000 the next year, and then 25 and 25 over the following years. So that piece of it is not being considered here as far as we're saying the machine was going to equally every year earn $50,000 for you, which probably, truthfully, isn't the case. Now, future other ones we're going to do, other calculations, we are going to consider the timing of the cash flows we're receiving. Okay, well, we're not. This is just an example. You can go through on your own if you'd like. Cash payback period, also a very popular one. The idea is, how much is the machine going to earn for us, and how long is it going to take to earn its initial investment back? Okay, so jump right into this. We've got cash payback period is a period of time. How long is it going to take this investment to pay itself back? So if you're looking to buy a piece of equipment and you're saying, well, how many years is it going to take for this equipment to pay me back? That's what your calculation is here. So it's the initial cost over the annual net cash inflow. So what that means here, when we look at this, is the cost of the new machine is going to be $200,000 for the year. So with that $200,000, what you have is you have your numerator here. Going back for a second, it's the initial cost over annual net cash inflow. That net is an important word here. Let me go down. Second, okay. Net cash inflow. Well, this machine is going to make me $50,000 a year, but it's also going to cost me $30,000 a year to run this machine, and it's got depreciation every year of $20,000. So if you look at that, what we're really going to consider here is, the $20,000 of depreciation is within this $30,000 of expenses in the machine every year. So the machine's maybe going to cost $10,000 in maintenance and $20,000 in depreciation. Well, depreciation is really a non-cash item, right? Depreciation is the using up of the asset over time, but it really doesn't have anything at all to do with cash. So within that $30,000, we're saying 20 of that is depreciation. So really the only true expenses for that machine each year are $10,000, maybe in repairs, maintenance, something along those lines. So we're looking at this from a purely cash perspective. We're saying this machine, the revenue from this machine is going to be $50,000 a year, minus the $10,000 in actual cash expenses for this machine. So the amount of the inflow each year, the amount of cash this machine is going to earn for us, remember we're disregarding the depreciation aspect, it's going to be $40,000 every year. So there is our denominator. So if we put this in here, it's $200,000 for the machine over $40,000. This machine, it will take 5 years of this machine working for us before we pay back our initial cost. Think about that. The machine's going to make $40,000 a year for us. It's going to cost us $200,000, so it's going to take 5 years for it to pay itself back.